Hello. In this video, we'll prove how trade can improve economic well-being using welfare economics. But first, what is welfare economics? Welfare economics is the study of how resource allocations influence economic well-being. To understand this concept, we need to discuss consumer surplus, producer surplus, and total surplus. Consumer surplus measures the benefit a consumer receives when buying something cheaper than expected. It is calculated by finding area A on the graph. Producer surplus measures the benefit a producer receives when selling something for more than expected. It is calculated by finding area B on the graph. Total surplus is the sum of all surpluses. It is used to measure overall economic well-being. We use these various metrics to understand how much a country benefits or doesn't, both conceptually and mathematically. Now let's talk about trade. Let's assume that a country cannot influence the world price by itself and is a small economy. When a country allows trade of goods in the international market, the domestic price becomes equal to the world price. This creates winners and losers, but generally, the winners profit more than the losers lose, so there is a net increase in welfare. But why is this? Let's see this with an example. Take a look at this graph. This is a hypothetical supply and demand graph of Canada's oil industry, whose domestic price is below the world price. Since the domestic price is lower, Canada has the comparative advantage in the good. It should export the good to other countries. Since Canadian sellers can sell their oil for a higher price on the global market, they win from trade and gain a larger producer surplus as seen in Area B. However, Canadian buyers now have to buy the goods for a higher price than they did before, meaning they lose from trade and have a smaller consumer surplus as seen in Area A. The benefit provided from trade can be seen in the additional Area C, which represents the gains from extra trade. Before trade, the total surplus was A plus B, but with trade, the total surplus is A plus B plus C, which means an overall improvement in Canada's economic well-being. But what if the country's goods were above the world price? It's the same situation but flipped. Take a look at this hypothetical example of Canada's coffee industry. Since the domestic price is higher, Canada has the comparative disadvantage and should import coffee. This time, the buyers win because they can use the lower world price. Sellers lose because now they have to lower their coffee prices to the world price. Like the last graph, the extra trade creates another area C, which represents the gains from trade. Once again, the total surplus is higher than without trade, meaning greater economic well-being. Therefore, we can see that unless the world price is exactly equal to the domestic price, there is always a benefit for a small economy to trade internationally. In this video, we talked about welfare economics and why trade can be good. Thanks for watching.